Hello everyone, here is the answer to exercise 3 of Unit 5 in AC201. In this question we have Gregory Groceries, and they have $10,000 worth of free cash flow which they can invest. They have 3 potential options to choose from. The first option is to invest the money in a 9% mutual fund which pays interest annually for the period of 5 years. Gregory is going to reinvest all proceeds from this mutual fund, so when they get that 9% payment each year, they're going to let it stay in the fund, so interest will be earned on top of interest. Their second option is to invest the money into a money market fund which earns 8%. The account pays interest quarterly. Gregory will reinvest these proceeds as well and do so for the next 5 years. And then lastly, their third option is to invest in a different money market fund that earns 10%, this time compounded semi-annually for the next 5 years. Again, they will reinvest. So the company wants to maximize returns. They want to pick the one of these 3 investments which is going to give them the greatest return. And for the return, it is just the future value of the investment minus their initial outlay, the amount of cash they have to put down. So let's start with the mutual fund. We need to figure out what the future value of the mutual fund is going to be, and to do so we're going to use the future value function of Excel FV. What are our inputs going to be? Well, what's the rate per compound? This is a 9% mutual fund. It pays interest annually, once a year. So if it's 9% once a year, it's 9% each time it compounds. Number of periods. They're going to invest this for a period of 5 years. It compounds once a year. That's 5 total compounds. And the initial outlay they're going to have is the $10,000 of free cash flow. So negative $10,000. If they invest into this mutual fund, they're going to have $15,386.24 at the end of the 5 years. What is their initial investment? Again, it's that $10,000 of free cash flow they wish to invest, which means if it's worth $15,386.24 at the end of 5 years, and they're paying $10,000 for this investment, their return is going to be $5,386.24. What about money market account A? What is the future value of this? Let's go back to our FV function. Rate is the rate of interest we get each time it compounds. It earns 8%, but that is for the year. It compounds or pays interest quarterly, which means that 8% is spread over 4 payments. So each one is going to be 2%. Number of periods, the number of times that it compounds. Well, we're going to keep the money invested for 5 years, and we know that it compounds quarterly. So 5 years at 4 times a year is a total of 20 interest payments, 20 compounds. And our present value is still that initial cash outlay of $10,000. So if we invest in money market account A, the future value of that is going to be $14,859.47. Our initial investment hasn't changed. All 3 of these, our initial investment is going to be that $10,000 outlay, which means our profit or our return on an investment in money market account A is going to be $4,859.47. So return is not as good on this potential investment as it would be on an investment in the mutual fund. Let's move on to money market account B. Again, we got to start by finding what the future value is going to be of this investment. Rate. This one earns 10% compounded semi-annually. Well, the 10% is for the year, which means each time that it compounds, we're going to get 5% interest. How many times is it going to compound? It's compounding twice a year for a period of 5 years, which means in total it's going to compound 10 times. And the present value is that lump sum payment we're putting in today of our cash outlay of $10,000. So if we invest in this option, our return will be $16,288.95. We still got to put in $10,000, which means our total return is going to be $6,288.95. So what's the best investment for this company? Money market account B, because it has the highest return on the $10,000 initial investment. In part 2 of this question, we have Donaldson Auto Group, and they offer a 2-year warranty on all used vehicles that they sell. Donaldson estimates the expected warranty cost related to their 2019 sales will have the following probability. So when you sell stuff that is under warranty, unless you have a crystal ball, you don't know exactly what amount of those warranties are going to actually end up being claimed. I mean, think about how many things that you've bought that have a warranty that you've never used. The same is true for anything that can be purchased. They don't know. So what do? They take their best guess at what the probability is of certain levels of cost. And for 2020, they think that $40,000 of warranty cost has a 30% probability of happening. $50,000 of cost has a 50% probability of happening, and the probability that they have $60,000 in costs is 20%. Well, what is the expected cash flow? We can figure this out by taking the estimated warranty cost at a level and multiplying it by its probability. We can do that for all 3 of our different scenarios. And when we get done with doing that, we can find the sum of these 3 expected cash flows to get our total expected cash flow. If we have these certain probabilities of paying this certain level of cost, well, overall, our weighted average expected cost is going to be $49,000 of warranties redeemed in 2020 related to 2019 sales. In 2021, if these warranties are still valid, and we're going to assume they are, we went through and we found what our estimated costs were and each estimated cost respective probability. We'll multiply those together. We have a 20% chance of paying $50,000 in warranty costs during 2021. We have a 40% chance of paying $60,000 in warranty costs, and we have a 40% chance of paying $80,000 in warranty costs. And when we find the sum of those 3 numbers, we figure out that in 2021, the weighted average expected cash outflow related to paying warranties for Donaldson Auto Group is going to be $66,000. So assuming the future warranty cost should be discounted at 3%, which is the expected rate of inflation, use these probabilities and a time value of money concepts to determine the amount of estimated warranty liability that Donaldson should report. So when you report your liabilities for warranties, it's not just the amount that you expect to pay that matters, it's when you expect to pay it, right? If we total those 2 numbers together, we come up with $115,000, $49,000 plus $66,000. Well, having to pay $115,000 today is a very different animal for a company than having to pay it 2 years from now. So what you need to do is you need to discount by the expected rate of inflation. So what we're going to do is we're going to find the present value of all of these numbers. So let's take the present value function. The rate that we discount at is, in this case, the rate of inflation. Money is going to be worth less in the future than it is today. It's just the way that it goes. So having to pay something in the future isn't going to be as costly to us because, that amount is worth less, has less economic buying power. So our rate is going to be that 3% rate of inflation. Our NPER is how many years from now it is. Well, we're making 2019 sales into 2020. That's 1 year, so we NPER of 1. And our future value, in this case, we've already figured out is our expected cash outflow. And let's make it negative. So negative $49,000. Essentially what that means is $49,000 today will be the same as $47,573 a year from now because the price of things keeps going up, so the buying power of any one given dollar keeps going down. In 2021 we're going to do the same thing. We're going to find the present value. Our rate of discount is still that 3% rate of inflation. We made these sales in 2019. We're looking for 2021's estimated redemptions on our warranties. That's a 2-year time period. And the future value that we expect to pay during that year is $66,000. So discounted, that $66,000 2 years from now is the same thing as $62,211 in today's money. And if we add those together, we come up with a total of $109,784. Why do we report liabilities like this? Because liabilities go on our balance sheet, which is a snapshot in time, is what we expect to owe today. Well, if we put an amount of money in the future on there today, it's not using the same monetary unit, because 2 years from now the value of debt is going to be very different than it is today. So what we need to do is discount that future obligation down to its expected value in terms of present value. And as an addition to this, how would you book this now that we know what the costs are going to be? Well, I'm thinking that on December 31st, 2019, we have to record the expenses related to 2019 sales. Why? The gap matching principle. Expenses have to be recorded in the same period they helped you earn revenues. Offering this warranty made our automobiles more attractive to prospective buyers. They helped us earn revenues. We recorded the revenues for the sale in 2019. We have to record the related expenses in the same period. So we're going to call that account estimated warranty expense. And what is our estimated warranty expense? Well, in today's dollars, but it's going to really be spread over the next 2 years, it's $109,784. Something that we owe in the future. We owe this debt to people. We offer them the ability to have this warranty. People are going to hit us up on that offer. We're going to have to fix stuff on these cars. We're going to owe something in the future, which means we need to record a liability, and we're going to call it estimated warranty liability. And that is for $109,784. What happened here is we recorded estimated warranty costs related to 2019 sales.